For more on the latest market moves, let's welcome in now Gargi Chaudhuri, BlackRock Chief Investment and Portfolio Strategist Americas. Gargi, it is great to see you as always. Obviously a lot of uncertainty and uneasiness with the tariffs and trade tensions, the policy uncertainty. Today, of course, the headlines all about Trump giving these auto companies some relief, Gargi. You think the volatility, I know, is going to remain relatively elevated from here. Against that backdrop, how are you telling clients they should be thinking about committing their capital?
Good afternoon, and thank you for having me. It's great to be on. And to your point, obviously, I was listening to your show earlier, and there is a little bit of relief in the markets, both in the stocks as well as in the bond markets, and that's welcome. We want to see that. But I think if we take a little bit of a step back, and we wrote about this in our outlook that we just published yesterday, our spring investment directions, where we just say that I think it's hard to believe that we're going to go back to sort of that, call it 2020 to 2024 period where we had relatively muted volatility. And right now, with the headline risk still remaining somewhat high, we think more and more investors should think about adding some ways to protect against higher volatility and adding more diversifiers in their portfolio. So that's the thesis of how you should be adding ways in which you can reduce the volatility, reduce the beta, and add diversifiers in your portfolio for the next couple of months.
So Gargi, let's talk, it's Julie, it's good to see you. Let's talk first then about that volatility muting piece of it. How does one do that in this environment?
One of the things that we were noticing was many clients were asking us if this is the period that they should be moving back to cash. And we've obviously seen historic inflows into money market funds, and we've obviously seen cash on the sidelines, call it 8 trillion or so. Instead of that move, what we're telling investors, those investors that are a little bit more afraid about some of the price action that they saw between sort of earlier this year to call it April 12th or so, what we're telling them to do is take a more defensive stance and add to solutions like US minimum volatility, which again, it allows you to stay invested in the markets, but just reduces the volatility experience, reduces the beta of your portfolio just a little bit. So on the days that the market is down, you just lose a little bit less. And of course, you still stay in the markets, you're still invested in US equities. So that's one way. So consider minimum volatility strategies. But then secondly, one of the other questions that have been coming up a lot is the behavior of bonds. Especially here, I'm talking about long bonds in particular, that didn't quite give you the ballast that you were hoping for, especially in the volatility in early April. So this is where we're telling investors, number one, continue to move your focus in fixed income to the front end of the market, to the belly of the market, and only on income generating securities in the fixed income market. Add in some inflation protection, some shorter dated inflation protected bond securities, and then think about other diversifiers like, for example, gold that has done very well in this sort of geopolitically fraught environment, and also other alternatives like liquid alts and market neutral strategies that don't have as much beta.
Gargi, I'm curious, when you're meeting with those very smart BlackRock clients, what's top of mind for them right now? What are the big questions you seem to get the most?
Yeah, so the big thing that's coming up is US versus the rest of the world, as you can imagine. And again, listening to your shows, I know you've been talking about that a lot. What to make of this international outperformance, especially since, we look at our own advisor portfolios and the data that we gather, where we find that investors and advisors are quite underweight international exposures. And, rightfully so, over the last decade or more, they've done very well having that underweight and having an overweight to the US. So one question that is coming up more and more is this a change? Should we reallocate back to international markets? And we are addressing exactly that question in our outlook by talking about ways in which you should be diversified in the international markets. We certainly think you should have exposure to international markets. And then the second question that's coming up quite a bit is around sort of, the diversification that we talked about. If we're slowing down in growth, Are we going into a recession? We don't quite know yet. But we know we're going to slow down in growth and maybe pick up a little bit in inflation. So in that environment, how should we think about portfolio hedging?
So you've talked a little bit about that volatility muting. You've talked a little bit about hedging through that lens, international. But I know that technology is also still a part of the strategy here, because I guess on the one hand, you want to minimize risk, but on the other hand, you still want to maximize returns. So is that the sort of thinking behind still turning to technology?
Julie, absolutely. And I was about to get to that while for some investors, the volatility has been a little bit alarming and they have asked us about sort of looking to reduce volatility, whether that be through minimum volatility strategies or option overlays, other investors are actually using this as an opportunity to add back to risk. And this is where we're telling them what we think is the most exciting opportunity here is to continue to add to those mega trends that we think will be with us for quarters and years. And AI is obviously top of mind and obviously big week with earnings and learning more about the CapEx plans of some of these large AI hyperscalers, but recognizing that this theme is going to stay with us for a long time. And now we're getting a chance to get back into these themes at somewhat of a sort of discounted level to where we were at the peak.
Gargi, final question. As investors look for opportunities right now overseas, there's been plenty of strategists who've come on this show and banging the table for Europe. You also point out, though, Latin America. Why Latin America? Why emphasize there?
Absolutely. And we do think that there are pockets of Europe that absolutely make sense, and European financials, and we're talking about European value a little bit, that we think completely makes sense, and going active with international. But the other often overlooked area, to your point, is LATAM, which isn't a region that many investors have specific allocations to. And in this rewiring of sort of, what's happening right now with geopolitical fragmentations and some of the rewiring of supply chains that's going to happen, of course, as a result of tariffs, we think that there are pockets of Latin America and Brazil and Mexico come to mind, which we think might be the beneficiaries and could also benefit from having some cheaper valuations compared to the US and parts of the European market. So, think about some of the exposures, especially, as I said, in Mexico and Brazil, as another way of thinking about diversification in your portfolio.
Gargi, good to see you. Thanks so much for joining us.
Thank you for having me.